Welcome to Markets Now. I'm Michelle Rook with StoneX's Arlan Suderman. We did see a mixed trade in both grain and livestock futures today. And in the grain specifically, we saw corn and soybeans lower, Arlan. And so let's start there. Soybeans, new lows for the move. How much of this has just been harvest pressure, hedge pressure out of South America?
Yeah, just a lack of demand, and a lot of that's because of the exports coming out of South America, Brazil specifically. We are getting a little bit more interest in what's happening in Argentina right now with their corn crop, where the leaf hopper seems to be spreading a disease. Some of the reports are we could see some significant losses. But at this point, we don't see enough damage yet, or enough evidence of damage yet, to justify rationing U.S. demand with higher prices. That's something we're certainly keeping an eye on. But meanwhile, the Brazilian farmer continues to be undersold and is now taking advantage of rallies to move grain. They've got to get it moved. They're pushing it forward, and that's putting pressure on the market. As we look at Brazil specifically on soybeans, they're expected to ship over 500 million bushels of soybeans this month alone. That's a tremendous export program as beans move from the farmer to the exporter and then out the ports. And that's hurting U.S. business. We did see a little bit of business, as I said, going to China in this morning's weekly export sales report, but it was mostly, it was previously sold to unknown destinations and then just redesignated in this port. So the actual new demand is lacking for both corn and soybeans, not enough really to build a story on. We had been ahead of the pace needed to hit USDA's target for corn on exports, but now we're starting to slip back on the sales side, shipments still strong, and just lacking a story to really sustain anything there, and beans pulling corn under with it.
No doubt. And then you get the funds that pile on top of that. And actually, we made some new lows for the move, and soybeans kind of broke out of our channel in the corn market. How concerned are you that we're going to take out the contract lows or go back and test them again?
Yeah, I'm watching those late February lows. Those are going to be key. If we hit those lows and bounce off of them, double bottoms usually hold. But if we bounce off and go back and test it again, triple bottoms oftentimes fail. So it's going to be key that we hold those lows from late February and are able to sustain a move. But right now, we simply don't have a fundamental story to justify that. We'd have to see something on the money flow side or something develop on the fundamental side. Right now, the rains are coming for the Midwest in a favorable way. A few areas are too wet, a few areas too dry, but overall, the market views what's happening as pretty favorable for the 2024 production.
Yeah, I was going to say we don't have a big enough weather problem or really any weather problem to help support the market either. Wheat, though, might be a different story. Weather, crop conditions might be supportive there. Is that part of the reason maybe we were able to kind of brush off the China export cancellations this morning?
Yeah, that weighed on Chicago early on. Those were cancellations, another couple cargoes of soft red winter wheat. But the hard wheat's a different story with dryness, really Kansas, parts of Oklahoma, Texas, eastern Colorado. And that area just continues to miss out on the rains. The systems come across the Rockies and tend to pull the dry air from the southwest into that region, and we don't get rains until the system moves past that spot. And they've been having some high winds, some high temperatures around 90 degrees, some dust storms in the area. And so we're seeing some rapid deterioration of the crop as it goes through its early reproductive cycle. So we expect some yield losses, yet to be determined how significant those yield losses will be. But that's helping sustain the market. Not enough to sustain a rally, but it does mean that we get buying on the dips. Capping off the rallies, though, is the fact that we continue to see cheap wheat coming out of the Black Sea. It's dry in many areas of southern Russia where they grow the bulk of their crop, but the crop's still looking decent. If this dryness continues, then we could change the narrative a little bit, but so far that hasn't happened.
Yeah. Arlan, would that be enough to get the funds to start covering shorts, or at what point would that happen in the wheat market?
You know, my observation after more than 4 decades of watching these markets is a weather story in Russia gets more play in the market than a weather story in Kansas.
Yeah.
And so if in fact we do continue and move toward hotter, drier conditions as we move into late spring and summer in Russia, Yes, I do think so. And it's primarily because the major exporting nations outside of Russia and Ukraine, supplies are really rather tight. And so right now, what's holding us down is those cheap Russian and Ukrainian prices. You start reducing that supply and allowing those prices to come up, suddenly the focus starts becoming on a smaller crop in Australia, a smaller crop in Russia, a smaller crop in the US plains, and the market starts paying more attention to covering those short speculative positions.
Right now, when you look at all the grains, though, the funds really are pretty content to stay short here, even going into our growing season, aren't they?
Yeah, we track the commodity index. We have our own StoneX commodity index, and we track a relationship with inflation expectations. As inflation expectations are going up, we tend to see money flow into the commodities, and it's a very strong statistical correlation. But here in recent weeks, we're seeing grain break away from that because it simply doesn't have a story. In fact, the story it has is a bearish one. So we're hoping we can get the grains to rejoin the rest of the commodity complex and starting to firm as inflation pressures start to increase again.
Yeah, the grains just were not invited to that party, that's for sure, Arlen. What about geopolitical risks with what we see going on in Israel and Iran? We've seen some volatility in outside markets and whatnot, but do we have any premium put into any of our ag markets, do you think?
No, we really don't. And that's because trade continues to flow out of Russia and Ukraine, the biggest export region of the world. Now, if we'd see a ship sink, that would be a game changer. But so far, while Russia and Ukraine have the capability to do so, they've been reluctant to do so because of the effect that would have on world public opinion. And so they haven't done so. If one side or the other gets desperate enough and we see a ship sink, that would change things. Obviously, that's not what we want to see happen, but that is a risk going forward. Meanwhile, Ukraine exports are almost at pre-war levels. Russia exports are relatively unhindered as well.
And with the volatility, we've seen money coming out of like the stock market and the equities. Is it to the point where you think we might see some of that money at some point come over into the grains? Is that another catalyst that might be able to push that issue?
That's possible, especially with the reinflation pressure starting to come back. But what bothers me now is the bearish fundamentals in the grain and oil seeds. They're not going along with that. The funds are staying content to remain short in those commodities. We're not so well supplied that we're immune to a weather story. That's not happening. But until we get a genuine weather story, we're adequately supplied, and there's the funds. There's really no reason to rally prices to ration demand.
Okay. So we've stabilized the cattle market back up a little bit here again today after the HPAI news, but now the market, just marking a little time till we get cash trade in that cattle on feed report?
Yeah, that's really what they're doing now. We're not immune to that HPIA story yet. I mean, I figure it's probably just a matter of time before we find a beef cow that tests positive, or a steer or something like that. Hopefully that's not the case, but it's only a matter of time. And then it comes down to how will the export market respond to that? How will our domestic big box stores respond to that? We were not aware of any human risk here, but you never know how they're going to react. And so that's a concern. But probably more concerning right now is the fact that we've stabilized the market, but our demand seems to be softening. Part of that's a strong dollar working on the export market. Part of it is domestically, the consumer seems to be shifting down the value chain from beef down to pork and poultry. So it's good for the pork industry, not so good for the beef, that we're not sustaining that steady demand.
It's at least been encouraging to see, though. I think the 5-area weighted average was only down the last 3 weeks, maybe $6 total. So at least the cash market hasn't, imploded or anything.
Yeah, absolutely. But when we look at the cash market, it's holding up better than where we were a year ago, while the choice cuts are worse than where we were a year ago. And so that means that we're really compressing those margins for the packer. And it means it's going to be more difficult for the packer to really pay up. We'll watch for those slower chain speeds. That means heavier weights for the cattle, more production to help make up for it. And if you look at the tremendous imports that we're seeing coming in right now, while actual domestic production is down from year ago levels, overall total supply is at or above year ago levels because of those strong imports.
Okay. Thanks for joining us as always, Arlan Suderman with StoneX. That is Markets Now.